Good evening, everybody. Welcome back to Strongman Personal Finance. Now, I've started this new thing where I go on Wall Street Bets and I find the stocks that they're pumping up. And I go and actually look at the stock's fundamentals to see if it's actually a worthy investment. Now, people on Wall Street Bets, do you think they actually go and look at the stocks or the company's 10K, which is the annual report? Somehow I doubt it. And yet they're still so convinced that these stocks that they're buying are going to go to the moon. They're going to go everywhere. They're going to go to Mars or whatever they're saying now, whatever. But you need to actually do your due diligence before you invest in a stock, okay? I don't recommend you invest in any individual stocks, but some people like to play around with individual stocks, and if you keep it to within 5% of your portfolio's total balance, that's fine. I fully support that. So today, we're going to look at BlackBerry because everybody knows that BlackBerry is going to be huge. Everywhere I look, I don't see iPhones. I don't see Droids. I see BlackBerries. Now, we're going to go look at the company's fundamentals, and we're going to see how amazing this company is because Wall Street Bets is pumping it up. So it must be an amazing company. Let's see. Share my screen. All right. So I pulled up BlackBerry's annual report, their 10K, which you should look at before you buy a stock. And this shows the past performance, the balance sheet, the income statement, all that stuff. So we're going to start and look at BlackBerry's balance sheet. The sheet that brings balance to the force, which I freaking lost it. Every time I zoom in, I lose it. Pisses me off. Oh, God, I got to go to the top. All right. Let's look at the balance sheet. Now, there's a couple things you want to look at the balance sheet. I've done a couple of these before, but you definitely want to look at the stock's current ratio, which is its current assets divided by its current liabilities, or its quick ratio, which is current assets minus prepaids and inventories divided by its current liabilities, because that will tell you if the company is more likely than not to be able to pay off its short-term debts. If it looks pretty bad, like if the current ratio is below 1, the company might be in some kind of trouble, not be able to pay off their debts. So let's go ahead and look at their balance sheet ending February 28th, 2021. That's the date of the balance sheet. It's a snapshot at a point in time. Let's see what the current ratio is. So you look at current assets. Current assets, it's under the assets column. Where is it? Where's total current assets? Okay. It's kind of crappily laid out, but I believe it's just 1,006. So we have 1,006. I guess that's $1,000,000,006 divided by their current liabilities. 429. Okay. So 2.34. That's not bad. You want it above 1. But if it's close to 1, that's still kind of iffy. But 2.34, that's not bad. So this company's probably not imminently in danger of defaulting on its debts. Now let's look at their quick ratio, which you have to take out basically any prepaids or inventories, which I'm looking on here. I actually don't see any. Interesting. How do they don't have inventory? Am I blind? Maybe it's under other current assets, but I'm not even seeing inventory. Whatever. All right. I guess we'll just say the quick ratio is the same. Now, the next thing we want to look at is the debt to equity ratio, which basically says how much of the company's assets are going to be potentially claimed by creditors versus investors if the company were to default. So basically, the higher the debt to equity ratio, the more indebted the company is. Now, you want it generally between 1 and 2. I mean, there's no ratio set in stone that you're looking for. It really depends on the industry. But you don't want to have a crazy high debt to equity ratio because the more debt the company has, they might have a hard time paying off their bills. So let's look. So we're going to look at their total liabilities, which I don't like how this statement's. It's kind of hard to read. I think their total liabilities are 1,314, which is 1.3 billion. So we have 1.3 billion of total liabilities, and then we have total equity. Where is total equity? Oh, God, this thing is so hard to read. All these other companies I've done are a lot easier. So I think it's the 1,005 down here. I think it's this. So let's go ahead and go with that. So it's already looking kind of encouraging. All right, it's less than one. That's not that bad. I mean, generally you want as little debt as possible. Debt isn't necessarily a bad thing. You can write off the interest on your taxes, and sometimes it's cheaper financing than common stock. But looking at this company's debt to equity ratio, that's really not that bad. So far the company isn't likely to imminently go bankrupt, and it doesn't have a lot of debt relative to equity, which, I mean, that doesn't mean you should still invest in it. Now, another thing I want to look at is growth in long-term debts. So you can actually look under the liability section and you can see long-term debentures. Now, debentures is just another fancy way to say unsecured bonds. Now, you look in 2020, they had no long-term debt. But in 2021, they took 720 million, it looks like. Yeah, almost $720 million of long-term debt. Now, that may be because they were able to get cheap financing or whatever, but that's not necessarily worrying yet. But they did take out a decent amount of debt, but we can look into that more later. All right, another thing, any increase in common stock, because generally when a company issues common stock, the current shareholders, their earnings are diluted. The company has the same earnings it has the same amount of earnings every year. But if you split those earnings over more common stocks, your earnings per share are actually diluted. So you don't want the company to be massively growing the amount of common shares that it has outstanding. That's the stock that you actually go and buy on Robinhood Stock or whatever you're investing in. So in February 29th, this is actually a little hard to read. It looks like they issued some shares, and we'll be able to see more of that in the statement of cash flows. But blah, 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 blah. Yeah, it looks like they issued maybe 10 million shares. I mean, that's not crazy. It's not a crazy increase, but you want to be careful because the company is like massively increasing the amount of shares they're issuing every year. Your earnings may potentially be diluted going into the future. So you want to be on the lookout for that. So far, I don't really see anything really bad on the balance sheet, which cool. It's not going to go bankrupt, but I mean, that doesn't mean it's a good company to invest in because you have to look at the income statement too. Is their revenue growing? What do their gross margins look like? Is it profitable, perhaps? Those are all important things to look at. So let's go ahead and look at, all right, that's the statement of equity. Whatever. I don't really care about that. I guess some people do. Well, I mean, I guess you could maybe see they issued stock. Yeah, I don't want to read that. It's too much work right now. All right, now let's look at their consolidated statement of operations. This is the company's income statement. This shows you whether the company is growing its revenues, which is just the amount of stuff it sells, and whether it's profitable or not. So they actually give you 3 separate years of income statements. You can compare the growth of the company's revenues over time. So if you look at the year ended 2019, throughout that year, they collected, it looks like $904 million of revenues. All right. And then the next year, by 2020, they were able to grow that to 1 billion. And then the year after that, it dropped back down to 893. So I am not seeing explosive revenue growth. This is not mind-blowingly awesome revenue growth. It looks like, I mean, I need to go back and look at like previous financial statements to see the general trend of revenue growth. But right now I'm seeing a company that might have had a good year in 2020 and then the thing happened. And then 2021, they had a decrease in sales, but whatever. I mean, it looks pretty flat to me, but we'll see going forward. But it's not explosive growth. Like I'm not enticed to invest in this company. Now we look at their spending or their gross. Let's start with their gross margin. So your gross margin is just your profit after you've sold your items, but not factoring anything else. So if you're thinking about a business that buys and sells stuff, simply looking at the gross margin, it's just saying what you bought stuff for and what you sell it for and how profitable you are from that. That's before you consider operating expenses like research and development, selling, marketing, administration, depreciation, all that good stuff. Now, the gross margin, okay. I mean, it seems like it's pretty stable. I don't feel like doing the exact math, but I guess I can do it for 1 year. So the gross margin percentage for 2021, you take the gross margin, which is 643 million, divided by the revenue. Wow. It's actually a pretty good margin, 72%. Let's see what it was the year before. 73. So it seems a pretty stable margin. So there's not crazy increases in the cost of their inventories. 904, 77. So it actually almost looks like their gross margin percentage is decreasing. Maybe they're having trouble, buying inventory at good prices or whatever. But it's a high margin. I don't know how it compares to the rest of the industry. But I mean, I would be a little worried because it's decreasing, which means the company's either selling the phones or whatever they're selling for less, or the cost of the inventory is increasing. So that's not really a good sign necessarily. All right, so then we have R&D, looks flat. Selling, marketing, administrative expenses. Looks like it went up and then went back down. I think the virus may have had a decent impact on this company, which it's not surprising. So let's go ahead and look at the operating income. So this is the income that the company makes before they pay interest and taxes. Now, for 2019, they actually had a positive operating income of $60 million. Wow. But then in 2020, and this is before the virus even happened or before it really kicked off, they had a loss on their operating income of $149 million. And then you look at the next year, wow, now they had a $1 billion loss. Tisk, tisk, tisk. Man, wow, not even profiting. This is a company I want to buy. And then we go down to the net income. So your net income factors in the interest payments and your taxes. So obviously the net income, it's going to roughly reflect the operating income. There's really not much. I don't even see interest. Am I blind? Interest, investment income, taxes. That's interesting. Okay. Maybe they just recently issued those bonds. So that's that. So the next thing we're going to look at is the statement of cash flows. So you have your income statement, which is based on the accrual basis of accounting, where you record revenue when it's earned and expenses when they're incurred. So it doesn't necessarily mean that you're spending cash or collecting cash. If you want to see what the company's cash flows are actually like, when they're collecting cash, how much cash they're collecting, you want to look at the statement of cash flows. You can't just look at the income statement and see if a business is viable. So let's go ahead and look at the statement of cash flows. So as I've explained before, the statement of cash flows is divided into cash flows from operating activities. That's money they collect from customers and that they expend on employees, inventory, basically stuff to run the business. The statement of investing activities, there it is. That's when they're buying or selling capital assets for their business, like property, plant, equipment, buildings, et cetera, et cetera. Or if they're buying investments, like short-term investments. And then you have cash flows from financing activities. Financing is basically the business getting money to grow its operations. So you can get financing from issuing common stock, which you buy in Robinhood Stock or whatever you want to buy it on, and debt. So those are basically the two main ways or the two main things that you'll see on the statement of financing activities. Now, when you're looking at the statement of operating activities, you want to see positive cash flow because a business should at least be generating positive cash flow from its operations. Yeah, maybe spending a lot of money on expanding its business. So, they may be spending a lot of money on this statement or the cash flows from investing activities, but you at least want to see positive dollar signs for statement of cash flows. So looking at the statement of cash flows from operating activities, I mean, they had 100 million net in 2019. Then it went down to 26 in 2020. And then it went back up to 82 in 2021. So it's kind of hard to tell, but I'm not seeing explosive growth. I'm seeing it's almost like it's flat, like that's not impressive to me where your operating cash flows are, flat, not really growing that fast. And they're really close to almost being negative, which would be another worrying sign for me. So far, I'm really not convinced by this company. Now let's look at cash flows from investing activities. So it looks like the biggest thing that they spent money on was short-term investments. They spent a lot on that, actually, $1 billion. And then they sold short-term investments. So it's almost like they're day trading almost. Interesting. So they're not really putting money into expanding the business. They're not buying property, plant, and equipment. They're buying and selling short-term investments. I don't know why, maybe to make a quick buck. You have to look in the notes or read the management discussion and analysis, but okay, it's almost like they're a day trading company, So that's investing activities. Then you have financing activities. So they repurchased some debt. That was their biggest outflow for financing, which, that makes sense. If there's lower interest rates, they can buy their debt back and then reissue debt at lower interest rates, which makes sense because look, they purchased debentures, which is just debt. They purchased them back and they were 3.75% debentures. And then they issued 1.75% debentures. So that's actually a positive sign because they're reducing their amount of money they're paying on interest. So cool. So that's it. So I'm just looking at these statements. I see losses every year, at least for the last 2 years. I see cash flows from operations that are not really growing. They're kind of flat. I mean, even if you factor in the virus, they're kind of flat. Their investing activities, they're not investing in growing property, plant, equipment. They're basically buying and selling short-term investments. And then they're basically refinancing some of their debt into lower interest rates. But overall, I'm not impressed with this company. I mean, the revenue's flat. They're not profitable. I don't know why this company has been targeted by Wall Street Bets as such a great investment. There's better stocks out there, okay? And this was me just skimming over the financial statements. Obviously, if you want to go and do more research, you need to read the whole freaking statement. You need to read the notes and understand their accounting policies and figure out really what they're doing, because they'll tell you what they're doing in their financial statements, or at least as much as they want to disclose to you. So that's that. Overall, I do not give this company a very high grade. Word on Wall Street is AMC will squeeze. I've been hearing that for the past, year. Well, if it happens, great, but I don't really care. Got the little hand symbol. All right, guys, any questions? I just wanted to look at BlackBerry real quick. I like going over Wall Street Bet meme stocks because I just want to see why they love them so much. I mean, I know, those hedge funds are shorting them. Oh, short squeeze. But, I mean, if you want to be a long-term investor, there's better ways. There's better things to put your money in than fighting the hedge funds with stupid meme stocks. So that's that, ladies and gentlemen. Please like, subscribe, and I will see y'all tomorrow. I'm actually tired. You can tell my energy is decreasing. All right. Baby strong man needs to go sleepy poopy. Later.